Hey there, investors. Welcome back to another deep dive into the world of finance. Are you on the hunt for a juicy dividend to add to your portfolio? Something that stands out in today's market? Well, HSBC is currently flashing a 7% yield. That's right, 7%. It's almost too good to be true, isn't it? In this low interest rate environment, a yield like that is like finding a golden goose. But before you get too excited, hold your horses. Before you back up the truck and load up on HSBC shares, we need to pop the hood and see what's really going on under the surface. Remember, a high dividend yield can sometimes be a red flag, indicating a company in distress. It's not always a sign of prosperity. When investors get spooked, they sell their shares, and bam! The yield skyrockets because the stock price plummets. So the big question is HSBC a diamond in the rough or a falling knife? Is it a hidden gem or a potential disaster waiting to happen? Let's dig in and find out. We'll examine the financials, the market conditions, and the overall health of HSBC to determine if this 7% yield is sustainable or just a mirage. First, let's take a look at HSBC's recent earnings reports. Are they meeting their revenue targets? Are their profit margins healthy? Over the past 5 years, how has their revenue trended? Are they growing, stagnating, or declining? Next, we need to consider the broader market trends. How is the banking sector performing as a whole? Are there any external factors that could impact HSBC's performance? And let's not forget the balance sheet. Does HSBC have a strong financial foundation? Are they carrying a lot of debt, or are they in a solid position to weather economic storms? Finally, think about your own investment strategy. Does adding HSBC to your portfolio align with your risk tolerance and financial goals? By the end of this analysis, you'll have a clearer picture of whether HSBC's 7% yield is a golden opportunity or a potential pitfall. Stay tuned. HSBC's recent earnings report was a real head-scratcher. On the one hand, they beat earnings estimates. That's good, right? Well, not so fast. Revenue came in below expectations. That's a big red flag for me. Look, I like to see companies growing their top line. That shows me they're in demand. HSBC's revenue decline is a concern, especially in this economic climate. We need to understand what's driving this before making any rash decisions. Now, let's talk about everyone's favorite topic, dividends. That 7% yield is tempting, no doubt about it. But can HSBC keep those payouts coming? That's the million-dollar question. To answer that, we need to look at HSBC's payout ratio. This tells us how much of their earnings are being paid out as dividends. A high payout ratio can be a sign of trouble, indicating the dividend is unsustainable. We need to analyze this ratio carefully. Listen up, folks. It's not just about HSBC's financials. We also need to consider the bigger picture. The global economy is facing some serious headwinds right now. Inflation is still a concern, and interest rates are on the rise. This could put pressure on HSBC's earnings. Higher interest rates mean higher borrowing costs, which could eat into their profits. We need to factor in these macroeconomic factors when assessing HSBC's investment potential. Section 5, HSBC in the news, a glimpse into the future. As we peer into the horizon of the financial world, it's clear that the landscape is ever evolving, shaped by the forces of innovation, regulation, and market dynamics. Keep your ear to the ground, investors. The financial markets are a symphony of information, and those who listen closely can anticipate the next big move. There's been a lot of chatter about HSBC in the news lately. The headlines are buzzing with updates, and it's crucial to stay updated with the latest developments. They're facing pressure from activist investors to spin off their Asian operations. This strategic move could redefine their market position and open new avenues for growth. This could be a game changer for the company. The stock market is already reacting, and the ripple effects could be felt across the global financial landscape. We need to stay informed about these developments and how they might impact HSBC's future earnings and dividend payments. Analyzing performance charts and understanding market trends will be key. Remember, knowledge is power in the stock market. The more informed you are, the better your investment decisions will be. Stay vigilant, stay informed, and always be ready to adapt to the changing tides of the financial world. Section 6. Weighing the risks. What could derail the dividend? Now, let's not get carried away by that juicy dividend yield. There are risks to consider. HSBC operates in a highly competitive industry. They're facing pressure from both traditional banks and fintech startups. This competition could squeeze their margins and impact their ability to maintain those dividend payments. We need to weigh these risks carefully before jumping in. Section 7, the verdict to buy or not to buy. So the big question is, should you buy HSBC for the 7% dividend yield? This is a question that many investors are grappling with, especially in today's volatile market. Honestly, it's a tough call. There are multiple factors to weigh before making a decision. There are both pros and cons to consider. On the pro side, HSBC's 7% dividend yield is incredibly attractive, especially for income-focused investors. On the one hand, that yield is incredibly tempting. It offers a steady stream of income, which can be particularly appealing in uncertain economic times. On the other hand, there are concerns about their revenue growth, the sustainability of the dividend, and the competitive landscape. HSBC has faced challenges in maintaining its revenue growth, and there are questions about whether it can continue to pay out such high dividends in the future. Additionally, the competitive landscape is fierce. Other financial institutions are also vying for market share, which could impact HSBC's profitability. This is a stock for investors with a higher risk tolerance. If you're willing to take on more risk for the potential of higher rewards, HSBC might be worth considering. However, it's crucial to have a diversified portfolio. Relying too heavily on one stock, even one with a high dividend yield, can be risky. Ultimately, the decision to buy or not to buy HSBC should be based on your individual risk tolerance, investment goals, and thorough research. Make sure to consult with a financial advisor to ensure it aligns with your overall strategy. Remember, investing is a personal journey, and what works for one person may not work for another. Make informed decisions and stay true to your financial goals. This is a stock for investors with a higher risk tolerance. Section 8. Stay ahead of the curve with regular market updates. The bottom line is this. HSBC is a complex investment. It's not a no-brainer buy, and it's not a screaming sell either. It requires careful consideration and ongoing monitoring. That's why it's crucial to stay up to date with the latest market news and analysis. Subscribe to our newsletter for regular updates on HSBC and other investment opportunities. Don't get left behind.